All right, welcome back, everybody. Shane Carter here, Hampshire Capital. Joined again today with our VP of Investor Relations, Eddie Austin. Eddie, glad you're here with us. And once again, another special appearance by our business partner, Nick Bouquet. Nick, welcome again. And today we're going to be talking about underwriting, which is, again, one of your special gifts and talents and a very important thing that we do here. So why don't you kick us off into what do we do in underwriting and what happens in that world?
Sounds good. Yeah, great to be here, guys. Looking forward to talking all things Excel and underwriting. My favorite pastime.
Yeah.
So in our last discussion, we talked about sort of neighborhoods, submarkets as being kind of our first pass at when a deal hits our inbox. What do we do, right? We
make sure anybody that sees this video, go back and check that one out.
Yeah, you have to.
There's a lot of good points in there. So go check it out if you haven't seen it yet.
Yeah. It's not just about the numbers, everybody.
It's not.
We take a whole different approach than just looking at the numbers. So, But assuming a deal looks good neighborhood wise, and we feel like it checks sort of our boxes there, then for us, underwriting hundreds of deals, we've really realized that it's all about the rent story, right? For us. And so, you can cut expenses, you can add other income. There's little things you can do here or there to pick up pennies, but you're stepping over the dollars if you don't have enough rent growth potential, right? And so, for us, we dig into rent comps next. So, we don't even really start to underwrite the deal until we look at the rents and we get 85 to 90% comfortable that we think we know where we can push the rents here. Right.
So hold on. So you mean to say that we get an opportunity, we check out the neighborhood, we like the neighborhood, and you're still not looking at the rent roll in T12 yet? We're doing a rent comp analysis next.
Yeah, I'm looking at the rent roll to understand in-place rents. Just that though, just in-place rents by floor plan.
Okay,
so
got it.
I want to understand, but I'm not in the Excel model pulling 100 levers and trying to get a deal to work. I want to understand where are the rents today, where can we take them over a reasonable period of time, which for us is, we like to see kind of 24 months is a good renovation window for us, conservative sort of timeline to renovate units. If rents are X today, where do we think they're going to be in 24 months when we're done renovation?
I got a question.
Eddie.
Maybe I've been doing this all wrong, Nick. So when I find a property, not on LoopNet, first thing I do, I grab a piece of paper and I'm like, sale price, cap rate, loan, 25% down, NOI, and then cash flow. So you're digging into it from an extreme educated level by going straight to rents. So you're understanding what the GPI could be before anything else.
And what you're doing is not wrong. It's just different because we're total return investors, and for us to hit the internal rates of return, annualized return that we're trying to get for our LP investors, we've kind of realized and learned that we need to build a certain amount of rent over between acquisition and realization of the sale of the asset.
Right.
And so. And you're not going to build, when I say rent, I'm really talking about NOI growth, net operating.
Right, absolutely.
Which is mostly a function of how much can you push your rents. Again, you can do some expense trimming, or optimization, same thing on other income, you can add some other income items, but you're just not going to build enough of that. You're not going to build enough of that to drive enough NOI to really create the value that we want to see in these type of investments.
And I think and by using that style, we're able to generate, a 20+% IRR to our investors. And we're also able to hit some impressive cash on cash numbers. And that multiple of, somebody puts in $100,000, like the Dallas deal that we're looking at right now or closing on, that's 2.58x. We're 2.5 times the money. Almost 3. We're just shy of 3. So that method's definitely working.
Yeah, and the other thing to add to that, so for us, rents are critical. So I take a look at the rent roll, then I just start to look at comps, right? And and how you pick comps is different deal by deal. Depends on density of the submarket, product type in the submarket, location. So again, kind of weaving it back into the neighborhood submarket discussion, understanding what the demographics are, and then until I get that initial pass of the rent comps done, again, I'm not doing any real underwriting. I'm just looking at basically underwriting the rents, but not underwriting the entire deal in its entirety.
So do you use rent comps that are within a certain age parameter of the subject property, or is it more location based?
It's really both. So it's proximity and age. And proximity, closer is better. And I typically try to keep it pretty tight. I mean, I like to keep it within 2 miles, particularly in these dense MSAs and markets we're looking at. I mean, 2 miles is forever in some of these. It's completely different area in some of these.
Yeah, it could be a totally different neighborhood, right?
But the upside of these big cities that we're looking at is they often have dense apartment concentrations. So within a mile, you may have 4 or 5 comps, and you got to put yourself in the tenant's shoes, right? Like Eddie's going to look at apartment at Summerland Springs in Dallas, or just throw out a name out there.
Yeah.
And there's 4 deals next door. That's what he's going to probably shop. If he wants to live in that area, he's going to shop those 5 deals, Summerland Springs and the 4 properties around there.
Yep.
And there could be a vast difference in rents depending on finishes, but they're probably going to be similar vintage. And let's say that's an 85 deal. I'm probably looking at I'm going to look at kind of a submarket rents, kind of within a 1.5 to 2 mile radius. And I'll look to see who's outperforming the property and where do we sit within, the totality of the property set there. And then I'm going to refine it down and say, okay, let's just look at 75 to 95. This is an 85 deal. Mm-hmm. Let's see where we sit in that set. And so it's a bit of it's definitely an art and a science in terms of figuring out kind of what you can comp to. But look, if you have a similar vintage asset within a reasonable proximity to your property that's got renovated units that are getting $200 or $300 more per month for the floor plans than you're getting on average, then I think you, with a fair amount of confidence, know that if you do something similar and you operate the property well, that you can get rents close to that number, if not at that number.
So
sorry.
Is this as easy as when you're looking at the asset, you walk out to your car and you jump on a rental meter and then you put in location and rent and bedroom size and then you pull that report?
Not really.
I had to thought in.
And look, I mean, there's a lot you can accomplish with data tools online, but you still got to get out there and you've got to get eyes on it because how stuff looks and feels in person is so much different than what the data. But look, the data, if the rents online tell you that there's not a real upside advantage to the property you're looking at, going and seeing the asset's not going to tell you a different story, right? But if there is a big gap, then you're going to want to go out and really walk the asset, walk the comps, talk to the teams on site, talk to leasing people, and understand, try to understand why the property you're looking at is underperforming the market. Is there really an opportunity there? And then what are the other people doing around you from not only from an interior renovation standpoint, quality of the interior of the units, but amenities, staffing, are people friendly, signage, little things, lighting, safety, all that kind of stuff ultimately adds up into kind of what the opportunity is.
So Nick, question I have is, when you're looking at this rent comp analysis, are you looking, or maybe the better way to say it is, how do you weight the rent by unit type versus rent per square foot? Is one metric more important to you or not? Or how does that play into how you analyze your rent comps?
Yeah, I think, we rely heavily on rent per square foot because for us, that's sort of the great equalizer. But I'm going to caveat that by saying the concluded rent still got to make sense within the market averages because residents, potential tenants don't think on a rent per square foot basis. Right. But just as an example, if you have an average floor plan that is within a reasonable range of what the market average is for one bedrooms, for instance, say it's 700 square feet, but your rent per square foot's 20 cents below the one bedroom square foot average, then you probably got some upside there, right? And so it's a bit of a balancing act where we're going to ultimately sort of think about the rents, the final rents in terms of total rent per floor plan, but we're going to compare that to rent per square foot and make sure that checks out as well, and vice versa.
Yeah.
So,
okay.
Because like you might have a floor plan that's 100 square feet smaller than the other one bedrooms in the market, and so it may look like on a rent per square foot basis you got a ton of room, but then practically speaking, your rents for a 600 square foot unit are higher than the 700s, and that probably doesn't check out.
Yeah.
So it is a balancing act, but I found over time the rent per square foot is probably the quickest way to get a barometer on the opportunity. But then you got to balance it out.
Yep.
Also, Nick, when we're doing this, are you looking at also, so, we're always looking at unit mix and 1 1s, 2 1s, 3 1 or 3 2s or whatever that may be. So with that, are you looking at the asset, it's a mix of, say, two 1s and 3 2s, and that is kind of where everyone is trying to go, is that's the style of apartment they're looking for. And then what is the rent for that? Is that that kind of a metric you also look at and pay attention to? As far as unit mix compared to the area?
Yeah, I think, we do look at, we somewhat pay attention to unit mix, but it's less about what the comparable properties have for unit mix and more about back to demographics and submarket, like what's that demographics and submarket, right? Like if you've got a $75,000 area, average income. So some of the demographics reports that we pull also show a percentage of single people versus married versus divorced within a given submarket. So we know that certain submarkets may be 50% single people. And so if we've got a property that's high in 1 bedrooms, it's probably okay, right? But if we're looking at a submarket where we've got 80% families and the incomes are $45,000, and it's likely maybe multi-generational families living together, which is very common in these properties, then 1 bedrooms could be a risk. It doesn't mean there's not demand for them, but maybe we can't push the rents like we thought, and we really might want to, that might, again, it sort of just informs the business plan, and it's something to think about, but it's not, we don't have any hard or fast rules internally around, we have to have XYZ unit mix. It's more about matching the unit mix to the demographics and the opportunity.
Yeah.
That answered my question exactly. Yeah.
And again, all of that is leading to ultimately part of the formation of the business plan and what makes sense and what's intelligent to do for this particular asset, given all those demographics you just listed.
Yeah. Yeah. You definitely don't want to buy a building full of 1 1s when nobody wants that.
No.
That's right.
And it costs a fortune to bifurcate it, to knock it down to make it, 2 1s.
Yeah, and some of that can be understood and mitigated too by looking at historic occupancy and, has a property struggled historically because of the unit mix. And, in a lot of these high growth, high demand markets that we're playing in, it doesn't really matter what the unit mix is. Occupancy is pretty strong and consistent. But again, I think it can give you the sort of second level thinking there is understanding, how does that unit mix fit into the sort of, the fabric of the area, right?
Yeah,
the mix of the
absolutely,
area.
yeah.
And so you do your rent comp analysis, and are you, when you're looking at the comps and sort of where other people are and what the pro forma rents are going to be, how do you gauge what in our business plan? How do you gauge what our pro forma rents ought to be or could be, and how do we underwrite that?
Yeah. I mean, I think we typically will start by kind of setting the rents as close to market as we can, just to sort of see. But then we'll ultimately, we typically don't overshoot the market ever. Actually, I shouldn't say typically. No, we never do that. We're always chasing rents or marking rents at a property to the market at most aggressive. We will likely try to shave 25 or $50 off that number to give us a little bit of cushion. But we're never sort of going into a market, looking at the comps and trying to make some broad macro prediction as to where this market's going to go. We want to piggyback off existing data for sure.
So is it safe to say that we generally would underwrite, given what you've just said, sort of our pro forma rents for, the end of year 2 are going to be at or slightly below what the market is today?
Yeah, I'd say we're underwriting to today's rents essentially, but we're not projecting our rents to grow any faster than the market rents should grow. So,
got it. Okay.
If our rents are $1,000 today and the market today is $1,200, we're coming in 1150, 1175 to give us a little bit of safety. But we're not coming in at 1300, assuming that the market's going to get a 5% bump this year kind of situation. So,
got it. Yeah, that makes sense.
Yep.
Especially given the market conditions we're in now, right? I mean, you got to be conservative on what that organic rent growth can be.
Yep. And, I think we've, the days of, I think, we're back to a 3.5% year over year average rent growth. So,
yeah.
Again, a lot of underwriting in the last 24 months has got pretty skewed with these sort of huge year over year, at least year one, year two organic rent growth numbers, which, if you timed it right, was supported, but it's pretty speculative and not sustainable. And so, for us, like, we need to see that even if we strip out any rent growth from an organic perspective, if we just mark the property to market, do we have a compelling value add story, right? And so that's an analysis that we do in the pro forma. Once we get to the rent conclusion, we'll look at all of that as well and sort of try to understand, and what I found is, like, there's a certain threshold that we need to be at on that initial rent comp analysis before we even get to a full underwrite. Like, if I look at the rents today in the market and we're only 8% under market, I'm probably not even going to underwrite the deal because that's just not enough. There's not enough there, right, to warrant another 2 or 3 hours of time to actually go through the full modeling and looking at expenses and T12 and other income and all the other levers that we ultimately pull. Because, these models they're great, but they're also, the more variables you have to play with, the less accurate the model is. And so at the end of the day, while we have a lot of ways to make our model very precise and accurate, there's only a few major inputs that drive the model. It's rents, it's cap rate, and it's and your rent growth and your expense growth assumptions.
Right.
Those are your big 3 or 4.
So go back to that on rent growth. I was at Best Ever Conference last year, and had a gentleman walk up, and he's like, "Hey man, I've been looking at a few properties, and I got some that you might be interested in investing in." We had a 506c fund at that time, and he said, I'm underwriting these properties at an impressive level, and we're underwriting at rent growth like 7%. And I went, I said,
that's too much.
I'm going to respectfully step away at this time because that's not something I'm going to raise money for or invest in personally. It's not a model that I think will continue. And that got into a whole other side discussion. But yes, I think there was a ton of people that really got involved in the hype and that fake pump of appreciation that we just went through of properties selling like they did, and people got excited and they underwrote some really bad deals for sure.
Yeah.
I mean, it was tricky because you almost had to do that to compete, right? Like, it wasn't. Yeah. I mean, if you were looking at a marketed broker deal, like, 95% of us are generally. We all see off-market stuff from time to time, but anything that was competitive, in order to win those deals, you had to really push the envelope of what was believable and supportable.
And
that's
I
right.
think that's
and I say supportable lightly because it's it's relative,
right?
Yeah. And I think
look, I'm not saying that we did that too, right? I mean, but we've come off of that in this environment now that we've all sort of cooled down and come back to, I don't say reality a bit, but just, looking more at the longer term historical trends and not the 1 or 2 year trends, but what's the 5 or 10 year trend in these markets, right?
Yeah.
And sort of using that as our baseline for growth versus where we were in 21 and 22.
Yeah. And I would even say, man, that this is a more, this is a more stable market condition. Right. This is more a steady state. Where we just were was not sustainable and not rational. Trees don't grow to the sky. Right. One of my favorite Peter Linneman quotes. And so this, I think this is a well timed and needed correction where we're going to be able to get back to fundamentals of the market.
I would agree because I think underwriting then, in my opinion, was unrealistic, and there was really no crystal ball knowing where this was going to go, how long it was going to go. And I think now we with education, we can underwrite, and we can continue as a company to under promise and over deliver on returns because we know how things are going to go in the future. Before, they were just unpredictable. Nobody knew.
That's right.
We did our best. We did a good job. We're still here.
Well, look, guys.
Shane and I.
Yeah. Go ahead.
One more thing, Dan. We always talk about how pro formers are wrong the day you close, right? So
that's right. No matter what, let's just make sure that they're wrong in the conservative way, right?
Yeah, and I mean, look, they can be wrong in either direction, conservative or optimistic. But I raise that statement to make the point that all why it's more important to actually look at where are the rents today and where can we take them on a mark-to-market basis, because that is a hard data point that's real. Right?
Yeah, that's right.
We know
it's supportable.
It's supportable. So regardless of what happens with organic market growth and trending, we know that we like to look at deals where we fundamentally know if we simply execute on the business plan, we can create value.
That's right.
And that we're not going to be relying on things that we can't control, like rent growth.
Yep.
So,
right. Yeah. Sure.
Well, look, guys, this has been a great session. We spent the bulk of the time really, talking about rent comp analysis. I think there's a lot more we can dive into in future sessions about underwriting. That's just kind of the first step. So I'm going to call this part 2 of the series of underwriting, and we'll kick it off again with part 3 in another episode. So thanks, everybody. Appreciate it.
Good. Thanks, guys.